Good morning. Thanks for everyone for joining me. I'm Mike Figuera, manager of the Sanlam Multi-Strategy and Sanlam Real Asset Fund. Hopefully everyone's been sent the presentation pack, so I'm going to try and run through both funds as an introduction. Some people I know will have seen the portfolios before. So if I can ask everybody to turn to slide 5 within their packs. If it's okay with most, I'll skip over the Sanlam part. I'm sure everyone's quite familiar with that. So just a little bit on the multi-strategy team. Actually, there's 4 of us on the team. We've introduced a new member, but he hasn't had a chance to grow a beard yet, so I haven't included him in the pack. For my sins, this is my 30th year in assets management, so I've definitely been around a while. Johan has been with me at Sanlam from day one. We joined Sanlam in 2013. Chris has been on the team for 3 years, and we recently employed another member, Josh Harku, who's come across from Sanlam's pension business. But we're not here to talk about us. We're here to talk about the funds. So turning to slide 6, just an introduction to the multi-strategy fund. It's got a very simple philosophy, and in my 30 years of investment management, almost every client that I've met has a very simple requirement, which is make money. But there's a second part to their requirement, which they often forget to tell you, which is if you can't make it, don't lose it. And that's our philosophy. So to participate when we can, and defend when we need to. So the multi-strategy fund is an absolute return fund. The component parts, we have an equity strategy, we have a fixed income strategy, and we have a real asset strategy. That real asset strategy is available on a standalone basis, which I'll cover as we go through the presentation. We produce returns from both income and capital growth. We have twin objectives. You don't lose money in the short term, and an inflation plus 4% target in the long term. We currently have, in fact, at the start of the month, we had 281 million pounds under management. We're actually now around 310, so we are seeing some very good inflows. The fund is a UCITS fund, so it trades daily. It's available in sterling, dollars, and euros. We hedge currency exposure. So if you're in the sterling vehicle, you're just exposed to sterling. You don't have exposure to foreign currencies. Equally, if you're in the dollar class, you're only exposed to the dollar. So there's no currency views being taken within the portfolio. As it's on the slide, I mentioned that we've done quite well. The fund has won a number of awards over the past few years, which myself and the team are very pleased about. Moving to slide 7, just the key statistics. I've mentioned the asset size is about £300 million. It is an absolute return fund, so the volatility, as you'd expect, is quite low. The volatility is about 3.2%. There is a distribution class available for those clients who want income. And for my sins, once upon a time ago, I was actually head of the trusts and charity business at Credit Suisse, and very aware that clients who require income want that income to be very regular. So in fact, we pay 25 basis points per month, and we have done that every month since mid-2015. So should you have clients who want income, it's good to know that it's monthly and it's a set amount. Performance, the fund has performed quite well. We actually have first quartile performance over 1 year, 2 years, 3 years, 4 years, 5 years, and since inception. So obviously we're very pleased with performance. You'll see on the page slight difference in performance between the sterling class and the dollar class. The dollar class actually has performed slightly better, but that just captures the interest rate differential between the two currencies. We have 98 holdings, 8 short positions. So we are an absolute return fund. 98% of the exposure is base currency. So again, regardless of whether you're in sterling, dollars or euros, it's base currency exposure. And the portfolio's correlation to other assets is quite low. So our correlation to equities is around about 0.5. To government bonds, it's virtually nothing. And even to the hedge fund universe, the correlation is about 0.4. So a very good component of a portfolio, particularly when you're looking for diversification. Turning to slide 8 and just talking about the actual strategies themselves. Essentially, we have three strategies: a global equity strategy, which is rules-based, so a systematic strategy, investing in equity indices. We don't invest in individual companies. We're just buying equity market beta. The thematic element of the portfolio is real assets. So here we're investing in physical assets, so infrastructure, renewable energy, specialist property being the main areas. And in the fixed income space, we operate what is essentially a ladder portfolio. Short duration, when a bond matures, we will roll out to the next maturity point. So a very stable element of the portfolio. I'm going to skip slide 9. It's probably something better perused at your leisure. It just shows you the exposures within the portfolio, which is very diversified. And indeed, slide 10 just shows the portfolio evolution over time. It's worth noting when we built the fund back in 2013, we launched the portfolio with our own money. We had a couple of clients who came in, so there was no seed money, and it wasn't actually up until the end of 2014 where the fund went over £50 million in AUM, assets under management, and from that point onwards, the portfolio was really able to access all of the component parts that you see today. And again, the impact that had, just turning to slide 11. My exposure to equities has come down over the period. We've made a much greater use of equity options within the portfolio. So making sure that we maintained exposure to equity markets, but limiting the amount of capital at risk. And obviously within an absolute return fund, and given the backdrop we had over the last 5 or so years, and indeed the backdrop that we continue to see today, we think that equity exposure with optionality is a very sensible way to approach markets. You also see on that chart our exposure to government bonds. We had a long period where we had no government bonds. The yields were very compressed. And even at the moment, we actually only have a 2% weighting towards US 10-year treasuries, which is part of the hedging portfolio